Chapter 1, Introduction to Assurance and Financial Statement Auditing. First, we're going to talk about the study of auditing. Auditing is more conceptual in nature compared to other accounting courses. We focus in accounting on learning rules, techniques, calculations that are required to prepare the financials. Auditing, we emphasize learning the framework of analytical and logical skills to evaluate the relevance and reliability of whatever system and processes that are responsible for creating the financial information that is summarized in the financial statements. As students, you have to learn the framework and then learn to use your own logic and common sense to apply auditing concepts to various circumstances and situations regarding the financial statements and what made up the summary information in those statements. Understanding auditing can improve your decision-making ability, which is what we want to do. And this includes business managers, accountants, and so forth, including the users of the financial statements, if they understand how we actually evaluate the information and provide an opinion based on that evaluation. There is a demand for auditing in our economy. Why? Because of the agency relationship between absentee owners, which are principals, and managers, which are agents, who produce a natural conflict of interest due to the information asymmetry. And if you'll remember, we discussed information asymmetry and the natural conflict a conflict of interest that is developed because of that. As a result of the asymmetry, the agent, which is the manager, agrees to be monitored as a part of their employment contract, and we talked about employment contracts. Auditing is the best cost-effective way of monitoring the information that agents put into the financial statements. The agency relationship between the owner and the manager produces this conflict of interest because the goals of each party is different. So we know principals, they want to know that they can rely upon the information, and agents may have different goals than the owner, more so about personal objectives. Could be position, could be power, could be bonus dollars, could be raises, etc. Also just could be reputation. A manager may want to have the reputation of increasing stock prices every quarter or every year, however that is done. So you see the self-interest of both parties. So therefore, we monitor what the agents put in there to give the principals some reliable information, or information that they can trust. If both parties seeks to maximize their own interests, it is likely that the manager will not act in the best interest of the owner. Hence, auditing. And so, a framework of auditing through COSO, through PCAOB, through GAS has arisen because of that. Okay, auditing is a systematic process, number one, to objectively, which means that we don't have any interest in the welfare of whatever client that we're auditing. So we objectively obtain and evaluate the evidence regarding the assertions about the economic actions, which are all the financial transactions and events that managers correspond in their financials. Okay, so auditing or auditors engage in auditing services, attest services, and assurance services. The auditing piece, we're gathering information to test management's assertions. In the attest services, we as auditors or practitioners, we issue a report on some subject or some single assertion that is responsibility of management. So that could be that their before tax income is correct. It could be that their evaluation of inventory is correct. It could be that some long-term liability has been properly recorded, such as if this was a global company and we were issuing a set of convertible bonds. IFRS requires that if they are convertible, that the piece that is convertible is recorded as equity and the balance of that is recorded as the note. So that's the attest service. Assurance services, we help the clients to improve the quality of the information that they put out. So we would go in, we'll evaluate how they actually put their financials together, what they include in non-taxable and before taxes income, what is included in their net income, what they actually booked as expenses, so on and so forth. So we will go in and help them to determine the best way to present their information in accordance with GAAP. That is an insurance assurance service. Okay. With auditing, the systematic process that we rave about is the planned, logical approach for conducting an audit. So we have to make sure that we are objective, and how we do that is through independence. And independence is one of our standards, our 10 standards, and we're going to go over the standards. But independence, if an auditor is not independent of the client, then users of the statements should lose confidence in the auditor's ability to report objectively, and that is our goal, to make sure that not only is the auditor independent, but the auditing firm is also independent. Remember, we talked about the circles that auditors run in, like if the executive board of, say, KPMG or Ernst & Young may be in the same circles as the VPs and presidents of a client company. So those things have to be disclosed and evaluated to ensure that the auditors can still objectively maintain an audit-client relationship without impairing independence. Okay, let's talk about materiality. I don't know why it's in Chapter 1, but it is, so we will talk about it. Okay. Materiality, the basic definition: the magnitude of an omission or misstatement of accounting information that, in light of surrounding circumstances, make it probable that the judgment of a reasonable person, reasonable is key, a reasonable person that relies on the information. Those reasonable people are the stockholders or the banks or whomever is some financier that is looking at these statements in order to make a decision. Okay, so a reasonable person relying on the information would have been changed. Their decision about the financials, or a decision that they're going to make, say for financing, would have been changed or influenced by the omission or the misstatement. That is our materiality definition. So materiality is going to be set by the auditor based on whatever basis that he's going to. It could be non-tax income, income after taxes. It could be income before taxes. It could be total gross revenue. It could be, if there's a huge change in equity, it could be equity. If the liquidity ratio is low, it could be liabilities. It could be whatever they determine that it's going to be. But the materiality is reflected in the standard audit report with the sentence: the financial statements present fairly in all material respects. So what that means is that based on our materiality level, the statements are fairly represented in accordance with GAAP and have no material misstatements. So going back to our definition of materiality, when we put that statement in our audit report, then the statement users can feel like they can rely upon the information that is presented to them, and they can make a well-informed decision. Okay, so let's talk about sampling in respect to materiality. Uh, it's just not feasible or cost effective for either the client or the audit firm to audit every single transaction. So, like for instance, in a small business, and there's maybe several hundred transactions, we might be able to examine all transactions that occurred during the period. However, it is unlikely that an owner of the business, even a small business, could afford to pay for us to do an extensive audit of every single transaction. Plus, we know if that is required, then we need to call in forensic auditors to do a task that large. For a large company, large public company, the volume of transactions is just too great for us to do an examination of every single transaction. So, the trade-off between the exactness or preciseness of the audit is the cost. So, it would just cost too much to do a forensic type audit on every single client. And so, therefore, most firms would never get an audit done, or if they did get an audit done, it would probably put them out of business. So, let's talk about let's look at this slide. Um, this is the financial statement audit process in a nutshell. So we have management, we have the auditor. So this is where the agreement comes into place. So the terms of engagement, the engagement itself is the agreement that what we're going to do, how we're going to do it, who's responsible for what, and at the end of the day, we're going to make an opinion. Also, in the terms of engagement, which is in the engagement letter, we decide how much it's going to cost, if we're going to have any specialists to come in, etc., etc. Okay, here is the responsibilities of management, which are also laid out in the terms of engagement. So they implement their internal controls. They conduct all the transactions, and they're responsible for all these things. They accumulate the transactions into account balances. These account balances then go into the financials, and then, of course, they issue the financial statements. Okay. For us, we obtain the evidence. Evidence comes from here. Okay. Then we test management's assertions. This is after the financials are actually prepared, but before issuance. Okay. So we test all the transactions that management has asserted that is correct. Then we determine the overall fairness of the statements based on materiality and the substantive testing that we have conducted. And then we issue the audit report attached to the financials, and we communicate these findings with management, and then they issue the financial statements. Remember, we do not issue financial statements. We have no responsibility for financial statements whatsoever. Okay. Let's talk about the major phases of the audit. I'm trying to see if I have a slide for that. Okay. The major phases of the audit. Okay. Number one, the client acceptance and our continuance with the engagement. So here is where we establish an understanding with the client about who's responsible for what and who's going to do what and how much it's going to cost. The preliminary engagement activities, we go and we talk to outside vendors, we talk to the banks, we talk to the predecessor auditor, and of course we have to get permission to do all these things. And we also do a computation of our audit risk, our inherent risk, our control risk, our engagement risk, etc. And we apply that number to the engagement. Then we plan the audit. This is our plan. It goes into our work papers, how we're going to do this, what we're going to test, how much of it we're going to test, what our sample is going to look like, which balances are we going to test, etc. Remember, we were talking about the umbrella, like assets. What are we going to test under assets? What are we going to test under current assets? What are we going to test under long-term, like PP&E and that type of stuff? Planning an audit. Once we get the audit program down, then we'll consider and audit the internal control. So the consideration piece is that we're going to go out and we're going to observe the internal controls that we have gotten the policies for, and we're looking at the processes, and we're going to watch the employees actually do it. Reperformance may come into play after we have seen either that it works or it has worked multiple times. If it does not work through employee observation, then we may reperform the control just to make sure that it is working properly, or if we need to contact management to determine if we need to tell them they need to change something or what have you, and that is done through a management letter. Next, we audit the business processes and related accounts. That is the substantive testing. Okay, previously we did internal control tests. Now we're doing the substantive testing on actual accounts. Okay, so we'll test revenue, we'll test expenses, we'll test equity, we'll test assets, we'll test liabilities. Generally, we will also test items on the statement of cash flows to make sure that the ins and outs look like they're supposed to look. But we do not generally have an opinion on a statement of cash flow, but it can be done if it is part of the engagement. Then we complete the audit. So the audit is done. We give all of the substantive testing and our notes and our opinion to the partner, and then they will evaluate the results. They will have a management discussion, which comes before we actually issue our report, because we need to let management know what we found, how we found it, and what it means. And then if there's any changes that need to be done on management part, we will give them an opportunity to do that. If they choose not to do it, then we would determine, if our initial opinion can stand, or if we need to change that, and then we actually issue the report to the audit committee. Before we do anything, part of the business risk that we evaluate is our understanding of the company's, the entity itself and their industry. So if it's something that we don't know or we don't have experience with, then of course, in the preliminary engagement activities, we will go out and find information, or go ahead and hire specialists. Okay, let's look at the audit report. Okay, we can issue one of three reports, or decide that we cannot offer an opinion whatsoever, which is part of our gas at this point. But if we actually issue a report, it would be one of three. It would be an unqualified report, a qualified report, or an adverse report. Okay, the unqualified report is a report that we want. Okay, the auditor will issue an audit opinion of unqualified, which means that the report is clean. Okay, that means that there are no material misstatements, and we did not find it necessary to qualify the opinion, okay, about the fairness of the statements. A qualified opinion is not the opposite of an unqualified opinion, but it is not a clean report. Okay, during the process of evaluating the results with management, they decide that whatever changes we ask them to make, they cannot make them, or they refuse to make them. So we will qualify the report with an explanatory paragraph that says the financial statements are fairly stated, except for this misstatement or this error or what have you. We can issue an adverse report, and in the adverse report, it's not a good report. Okay, so basically what it's saying is that the financial statements are not fairly presented in accordance with GAAP, and the information therein should not be relied upon by financial statement users. Okay, in our report, there are 4 paragraphs. Okay, and you need to make sure you know this. The 4 paragraphs in a standard unqualified report are the introductory paragraph, the scope of the audit. So we would have a scope paragraph to explain what we did and what we did not do, and then the opinion paragraph, and then an explanatory paragraph referring to the internal control. Now, there are audits where the 4th paragraph to explain the internal controls, or what we thought about the internal controls will be in a separate letter. 9 times out of 10, it will be in the same letter. So the first paragraph is the introduction. The second paragraph is the scope of the audit. The third paragraph is the opinion. Okay, remember, the third paragraph is the opinion. And an explanatory paragraph, which is the fourth paragraph, that details our audit and evaluation of the internal controls. Okay? Alright, so lastly, auditors face situations where there's no standard audit procedure that exists. For instance, if there's text verifying the inventory of cattle, which is in your book, such circumstances require the auditor exercise creativity and innovation when planning and administering audit procedures where little or no guidance is preceded. So we don't have, maybe for instance, the predecessor auditor. There was no predecessor auditor. This is a brand new company, and we're talking, their inventory is cattle. So we have to understand that every client is going to be different, and we apply our auditing concepts in different situations based on our logic, our experience, and common sense. So if this comes up, and the one I like to use is the diamonds, because there's only two companies that are makers of diamonds, and so most times, now it's probably not a giant issue because we have Deloitte and Ernst & Young that are on those audits, so they have gained the experience. But if, for instance, they got rid of them and got, say, a single auditor to go in and do that, then they would have to either hire somebody from Ernst & Young to come in and help them, or they would have to figure out how to apply the auditing concepts, to apply gas to this particular audit. Okay, so that is the end of chapter 1. Please review and save this file so that you may refer back to it. You may take notes. These notes, you won't be able to use the actual video during the exam because it wouldn't be feasible to do so. But make sure that you take notes. All the information that was presented here will be tested going forward.